All right, good morning, traders, and welcome to the Pro Trader webinar series. It was all last week, and we continued to Monday today, where we have Nicholas from Datadash. He's a crypto trader. So looking forward to this. We've had Nicholas before. He's the founder of Datadash, one of the largest crypto YouTube channels with over 500,000 subscribers. And then he's an international speaker, thought leader, and crypto analyst in the space. He's utilized his over 10 years of experience in traditional markets to understand the potential of cryptocurrencies. And I have his contact information here. I'll be putting this into the chat so you can click on the links directly. You have his website, his YouTube channel, and Bookmap specials from Datadash as well. Let me go over the risk disclosures, and then we'll turn it right over to Nicholas, and we'll let him take it away. General disclosure, all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Risk disclosure, trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. All right, so welcome, Nicholas, and let's get your screen up here and I will broadcast it to YouTube.
Awesome. Thank you for having me, Bruce, and thanks for all of you tuning in today. I'll go ahead and pull up the screen here. And you just let me know whenever you're good to go, Bruce.
Oh, yeah. Oh, excellent. We're all set. Sorry about that. I was muted for a
Cool.
minute.
No, all good. Thank you guys for making the time to join in. I appreciate it. Bruce, thank you as well for the kind introduction. It's been awesome to be working with you guys over the past year. So thank you all for making the time to come out here today because I want to spend some time to talk about something that's relatively critical, I think, for the time being, whether you are a short-term trader, kind of midterm or long-term trader. It really doesn't matter what time frame it's on. We're entering into a really interesting time when it comes to financial markets, and that's going to leave us in a much more choppy market. I want to spend some time today to talk about something I've discussed a lot on my channel, where we're essentially preparing for what I define as an extended bear market. I want to talk about how price action, our analysis through tools like Bookmap, and the macro conditions are starting to signal a changing environment for traders. And this comes at a time as well when in crypto markets, derivatives are playing an ever more larger role in the space, and we need to be prepared to understand how that price action can give us some cues as to what's really going to come next. So I want to go ahead and start off here by talking a little bit about observing price action and market metrics. So for me personally, I always start off with trying to get an understanding of where we stand with price action and market metrics in order to build a thesis for where we might be heading going into the future. And then I really continue to build upon that potential setup by diving through the market order flow and Bookmap, which we'll talk about in a bit, and really considering the macro ramifications for the underlying liquidity in the system and a lot of other things that can play a role in price action. So the first thing I want to talk about here is price action. I want to dive into Bitcoin on multi-time frame analysis from the kind of daily, weekly, monthly timeframes, utilizing one of my key momentum indicators that I think will give us a telltale sign about where we're heading. A true altcoin market cap measurement. This is a custom metric that I build within TradingView that I utilize in order to track the actual market capitalization of altcoins, excluding ETH and stablecoins. Along with that as well, we have market metrics such as stablecoin liquidity and stablecoin dominance. This is really huge and relevant considering the narratives driven around Bitcoin right now that there is a supposed bank run from traditional banks into crypto assets as a safe haven. I want to try to counter that argument here as we go throughout the conversation, and of course, altcoin dominance. So let's go ahead and take these one step at a time. I want to start off with Bitcoin here because, when we're trying to determine a trend here for where Bitcoin stands, it's really difficult. We came out of a period of time where we had about 100% move from the lows back during the FTX collapse and back in November 2022, all the way up towards the relative highs at nearly exactly $31,000 in April 14th. So mid-April here, after just a couple of months, really since back here in January, we had a seismic move. But I want to go ahead and talk about why the price action we're seeing now is relatively predictable here when it comes to the circumstances that we're in, and this will play into the macro thesis later. But let's just go ahead right now, put aside any narratives, whether we have an opinion that we're in a bull market or bear market, right? I want to emphasize that for me, I'm a long-term investor, or more specifically, a long-term swing trader. I like to find trade setups that are going to play out over a generally, kind of 1 to 6 month time frame. I'm not looking to day trade. I'm not looking to do trades on the weekly time frame. Really, it's very rare that I'm going to be chasing those kind of setups. Maybe during peak euphoria, during bull markets, or during capitulative events, during bear markets. That's again a very rare scenario. For me, I like to utilize my tool suite to make trades, just a couple major trades each year at max, sometimes one big trade that really can double or triple my portfolio. So how can we go about actually doing these kind of trade setups? Well, first off, we need to take a look at momentum. Momentum is one of the biggest things here that we need to keep on our radar. One of the key momentum indicators I like to utilize is one known as Trend Magic. This is an indicator that's been utilized. It utilizes average true range as well as the commodity channel index, that essentially will allow us to have an aggregate indicator on momentum and let us know when essentially trends are starting to shift in either direction. I'm not really too big on utilizing indicators, nor am I big on using them during shorter term timeframes. So as much as I really like the indicator here, it is one of the few that I actually like to utilize. You guys can get it set up on TradingView, searching it within the indicator toolbar. But outside of that as well, the key thing for me is I like looking at it on longer term time frames, because basically if we look on the daily time frame, this can help us capture some pretty big moves here when we actually get the flip on these indicators. However, at the same time, again, I'm a swing trader. I want to know, when am I having a confirmed setup, essentially not just a small term window of time where momentum might be fading, which could be met back with buy side pressure, like through a large part of the sell off here since April, since we've been pulling back around 30,000. Well, I take it here to the weekly time frame. And so far, on the weekly time frame, we are not seeing a red flip just yet. So far, the bulls are in charge. But we can see that generally, when we do get those flips, if we do get a red flip here, it's usually that those flips are going to hold for a long period of time. So this is why I lean into Trend Magic as an indicator. It's really time tested. It was built way before crypto markets existed. And essentially speaking, even though on the daily time frame we are starting to see weakness, I'm waiting for that confirmation on the weekly time frame, because this goes into playing into my bigger thesis here, the long-term liquidity contraction and long-term bear market that we're experiencing right now. Now, notice here when we play Trend Magic on the chart, and what I can even do here as well is I'll pull up the all-time history index so we can really see this over the long term. Trend Magic on the monthly time frame has been your kind of go-to indicator to let you know when a bull market's kicking off. And again, this is not some kind of back-created indicator just to match Bitcoin. This has again been around way back, I think, since the 90s. It's a time-tested indicator that was usually utilized in forex markets. What's really interesting about this is that it's practically every time caught the kind of beginning move from the bear market lows, if you will, not the absolute low, but really the turning point where the vast majority of gains come in for the bull market, right? We can see that here in April 2019, we can see it here in October 2015, and we can see it as well back here during December of 2011, right, when we got the blue flip essentially. So that means that bulls are in charge, they're taking the trend, momentum is strong. And it really is telling because it's on the monthly time frame. However, we've been able to make about a 100% move here since back in around November and December, since the collapse of FTX. And while the daily trend has had multiple weeks and periods where it was blue, the weekly time frame is in the blue as well on a consecutive basis since back in around late January. Right now on the monthly time frame, and I put significance towards these longer term timeframes, we are seeing that Bitcoin has not gotten the flip after multiple green months here. So what's really going on here? What is the indicator telling us? It's telling us here that we've had an overshot relief rally and that we haven't gotten to a high enough price point to essentially, after considering the corrective period that we've gone through, we have not gotten towards a heightened enough price, which is somewhere around the kind of 32, 33K range, to really claim bull market status, to claim that we're ready for another major upswing in the market. Now, again, I don't want to just lean into one indicator or analyzing price itself. The key thing, though, is that this past 2 months of price action, the chop we've seen, is easy to understand when we start diving into some of the other metrics here. First off, again, analyzing the market metrics, I really want to get into Bookmap here and kind of talk about how that market order flow is kind of exposing itself in a sense, how essentially you can start to see what's happening under the scenes when you use tools like Bookmap versus just price analysis. But there's already enough signs here as well, I think, that already kind of gauge some conservatism when it comes to expectations for another bull market. This is another custom metric you can build within TradingView. It is Total 2, which is measuring all of the market cap excluding Bitcoin. And what we do do is we subtract Ethereum, we subtract USDC and USDT. This gives us a generally good picture, minus a few stable coins or outliers, about what the value of the altcoin market is. And what we can see is that we're not only a far cry away from where we were back in November 2021, but essentially that we've continued to face resistance at a key price range here that used to be prior support during the last bull market at around $330 billion. We have not been able to reclaim above that range since we collapsed through back in May when we retested it. And it has since then served as a resistance point where time and time again we continue to set slightly lower highs and lower lows. And this is again a sign here about not to get caught up in relief rallies. While we got on the weekly time frame that flip here, again on the monthly time frame, if we zoom out, we can essentially see that the trend has been in the red. And the key thing is this: we want to know when it's time to just get on the train and ride it. And when we can't get the train to show up to the station, if we can't get a blue flip here on our momentum indicators in the monthly time frame, we have to ask ourselves the big question: are we really ready for another bull market? That's the question I want to answer here, because crypto bull markets don't tend to last as long as traditional bull markets. And that's actually kind of a good thing, because the gains not only far outpace traditional bull markets and equities, but they really give us, in a short window of time, some opportunity to make life-changing returns. So I'm not too much rushing on a 40-50% move in altcoins. I'm not rushing when Bitcoin goes up 100%, because if I don't have the circumstances that let me know with certainty to a large extent that we are going to be moving higher, I'm not going to be chasing that trade. Right. So again, we can see this in both Bitcoin, the more defensive asset, on that monthly time frame, and we can see it here on altcoins as well. We were not able during this move to continue accelerating enough to get a flip on that indicator. And that, for me, throughout all my trading years, this has been one of the most consecutive indicators that I've seen here. And it's readily accessible for people to access, right? Third thing here as well that I want to talk about is stablecoin market cap. Now, this is something that I haven't really seen many people talk about, but I think it's imperative here. We always hear about how people say how the Fed's just going to print more money and lower interest rates, and by bolstering credit in the economy and the amount of liquidity, the assets are just going to counteract. They're going to continue to move higher and kind of be cushioned by that liquidity. However, while this has been incredibly true in the crypto market, say back in the last bull market, or excuse me, the last bear market into the next bull market from 2018 in December all the way towards February of 2022, we had stablecoin liquidity expanding rapidly from around an estimated $2.3 billion all the way towards $138 billion. That's what it took to give us the bull market that we saw, from roughly around at that time $3,000 Bitcoin all the way towards a 65K Bitcoin and a whole swath of altcoins and NFTs and you name it. Well, we can see that on a logarithmic scale, this was a huge rapid amount of stablecoin expansion. I think the figures alone stand out quite decently alone on their own. But if we take a look at the past couple of months, actually really the last year, since April of 2022, stablecoin liquidity has actually been on the decline, really for the first time to such a significant degree, even on the log scale here. We've seen liquidity contract by roughly around $23 billion. And that's not a good thing to see here, essentially to see over $20 billion of net liquidity coming out of the market. Now, since we got those lows around November and December, liquidity has expanded by roughly about $2 billion for stablecoins, for USDT and USDC. So we need to ask ourselves here, do we have the liquidity to really back the next cycle? Are we seeing the main institutional on-ramp, which is stablecoin liquidity? I know some people will say, well, can't people just go on Coinbase or exchanges and just buy with direct fiat? But it's important to note that the stablecoin on-ramp is how the vast majority of liquidity actually comes into the crypto space. Institutional liquidity comes through these on-ramps, especially through Tether. And if we're not seeing that expansion now, what is that telling us here about the current state of the market and the price action we've seen and whether or not it can actually hold? I'll give another great metric here. One other great thing is that even if you believe we are in a new bull market, one important thing to turn towards is a measurement, another exclusive one that we had created a while ago, which is dominance on stablecoin liquidity. So again, taking in the market share of USDT and USDC. And we can see that these players roughly own about 10% of crypto market cap. So that trillion, I think it's probably trillion, $1.2 trillion figure, but just Bitcoin, altcoin market cap, ETH market cap, and stablecoins. This shows that roughly stablecoin liquidity is up about 10% of the market. Now, why is this an important metric to watch? Essentially, it shows us that over time, as we add more altcoins to the market, as valuations generally are at heightened levels, you need more liquidity to justify those valuations. If money is leaving the cryptocurrency space, like stablecoin liquidity, fiat currency is leaving the system. Order books are getting thinner, less buyers and attention are being brought to the market. Then essentially, we need to have discounted prices. We need to get it at a point where basically stablecoins make up a much larger share of the market. So what I generally watch for, just to kind of extend it out here, is that I'm waiting for essentially stablecoin liquidity to come up into this band here, somewhere around 25% market share. Because when we get up to a point where stablecoins make up such a large portion of the market, that likely means we have discounted prices. We have stablecoin liquidity either where it was before or at increased levels, and that's going to lead towards a lucrative environment. There's more dollars readily available to go out there and purchase Bitcoin. And you can see just how consistent this has been throughout time. So we can see between the highs and lows, sometimes with exceptions, a little bit lower, sometimes deviating outside the range. But generally speaking, this is where the opportunity lies. And right now, where we are, well, we're right back down to this band. This is exactly where we were in the sense of the line that's been built here back in November 2021, back here around March and April and May of 2021, where we were having our first top of the market, and also here in June 2019 during the relief rally. That is not a good look here for crypto. So it likely means that in the near term, whether we're in a bull market or not, we're in an overbought period of time, and it's best to wait for a correction. It's best to wait for periods like December 2018, periods like March 2020 when Bitcoin went practically right back down to its bear market lows, periods like October 2020 when really we got the first major beginning of the on-ramp towards the bull market and really kind of got out of this kind of questionable territory for Bitcoin, and of course the mid-cycle correction point in July of 2021. And last but not least, want to take a look at here is altcoin dominance. So we can see that essentially, excuse me, not altcoin dominance, but rather in the opposite countermeasure, taking a look at the dominance of Bitcoin, ETH, and USDT and USDC. Now, this shows us that the vast majority of the market is owned by two parties. Defensive plays, Bitcoin and Ethereum, and stablecoin liquidity, USDT and USDC. When these large players are continuing to make up a larger share of the market, this shows that the market is taking a less risk-on approach. Stablecoin liquidity is rich in the market, but on top of that as well, we're also seeing that the defensive plays are making up a larger share of the market. And this likely means, more specifically, that altcoin dominance is bleeding, that altcoins are making up a lower share of the market. And again, we already saw here that we're pretty much looking like we're ready to roll right back down to this range here. If Bitcoin isn't looking bearish, altcoins are definitely looking like it. And we basically have been writing about this for the past year in our newsletter that essentially we believe we kind of closed our positions back in August during the first relief rally. And for a lot of the altcoin positions, so many of them, maybe Bitcoin has gone maybe a couple $1,000s ahead of where we would have sold it. But the altcoin positions were sold at a much better price than where they are now. And it's because we believe that, altcoin cycles are very rare, historically speaking, and we want to buy into altcoins when there's basically a favorable environment to take risk, when the defensive plays and stablecoin liquidity make up a lot of the market share, because that means we have cheap altcoins and we likely have a strong Bitcoin and Ethereum, and we have a lot more stablecoin liquidity. All of which are conditions we just don't have yet. We don't have that stablecoin liquidity. Bitcoin is, while it had a great move here, it's been stagnant for 2 months. This is not typical bull market activity. So we need to be very cautious here about what we're seeing within the metrics and whether or not we're going to actually chase the narratives. Again, going back here to dollar liquidity, people have been saying people are running from the banking system, but we're not seeing it within the stablecoin metrics. We should be seeing it even more at a faster acceleration, but maybe not the logarithmic scale. But we should be seeing a net increase equal to prior bull markets or greater. So this is again a big part here that I think is important to focus on. However, I want to go ahead here and talk a little bit about how Bookmap can really accelerate our analysis here. Now, I know a lot of you out there who are probably watching might be very well more short-term traders. There's nothing wrong with that. I've done day trading and swing, more shorter-term swing trading in the past. If you can build a process and a framework, and your markets and the types of assets you like to trade, then it can be really great. However, as you all know, using Bookmap, it gives you that additional edge when it comes to doing short-term trading. But I even want to make the argument here that can help you with long-term trading as well, because Bookmap measures a lot of key things that you just cannot get with traditional price action analysis, going beyond what the chart is presenting you. For me, I actually like to focus a lot on some of the core fundamental elements like multi-book and cumulative volume delta that Bookmap has to offer. So I wanted to go ahead and kind of pull up this chart here. We'll dive into we can dive into the live version as well, but I took a snippet here of really the past, kind of weeks worth of price action, roughly speaking. And what's interesting is to a trader, kind of in the short term, people are looking at this and thinking, okay, this is potential range. We got, a couple deviations around these ranges. That's what I'm looking to basically kind of counter trade, just trade the ranges, make some short term returns. And that's all great and everything. But for me, doing those kind of longer term swing trades, like the 100% move we saw in Bitcoin here, I want to know whether or not we're going to have that next big move to the downside here or the next big move to the upside. And Bookmap can really help us do that because while this price action looks inconsistent, it looks like pretty much it's been unchanged for about a week. What's happening behind the scenes is very different. Within Bookmap right now, we're seeing over minus 10,000 on the cumulative volume delta for multi-book. So what I do here, and this is something that again I don't think many people will utilize within Bookmap as an application, there's this little arrow right here that will allow you to draw back over a certain period of time. You can see the heat map, you can see price action, the volume bubbles, as well as the cumulative volume delta, and generally not only see how the market structure is changing. So this is very important here. So you can see essentially where bids are coming in, how they're changing over time, did they get filled, which can give you a lot of information as well. But for me, I really care about that cumulative volume delta. And the reason I care about that is because while price action has been relatively neutral over the past week, I'm seeing consistent major bubbles of sell side volume into any bids on the order book. And this tells me that there is some large player or pairing of large players who are essentially getting out whenever possible at suspended prices. They are not waiting for us to go back to all-time highs. They are continuously unloading onto the market, having these big sells, waiting for price to kind of drive back up with some additional kind of short-term bid support, and then just continuing to offload. They've been doing this week by week by week over the past couple of weeks. And this is why even back in early, towards late March, early April, we actually talked a lot on the channel about generally how this distribution has been playing out and how relief rallies and how when price kind of chops sideways, like what we've seen, I'll bring back here to the daily time frame, how this kind of activity, again, especially with the narratives we've had around the bank run, around de-dollarization and how the dollar is going to collapse, all this stuff starts to come out once we've had the expansion of price. Because now market makers, large players, institutions, exchanges, whoever is in there being exposed from these long-term moves, they can slowly unload at much higher price action. And that's, again, exactly how it plays out. We keep running up to the prior relative high, just at a slightly higher range, offloading. We drive up to new relative highs. We chop down, have a nice flush over the next couple of days. We set in lower highs here, and then slowly but steadily that market structure starts to break and it can no longer hold anymore because sell side pressure starts to outweigh any bid side support for people who are preparing for the next move to the upside. That's at least how I interpret it here within the market. And I think cumulative volume delta can give us a really big telltale sign here on the weekly time frame. It's not just about trying to analyze, what's going on here in the near term, zooming in exactly into the shorter term time frames. It can be very powerful for that. And that's, again, some of the other tools I like to use on the shorter term time frame. If I were to go back to doing more day trading in the market, especially if I were in like, say we were in like a bull market or, I felt that there was some good ranges to trade, I would definitely use the liquidation tracker. That's another great tool that you can utilize in order to actually understand, with derivatives now, the exchanges are trading against the user. That's the important thing you got to understand. So it's not a matter of going in with a lot of leverage and inevitably being the trap of the exchange who's making money from your liquidations. But you want to actually find out the suckers who are essentially going in with too much leverage. When they get forced out of their positions, whether you're trading futures or perpetuals, I want to see when they're getting liquidated. And when we get those high tickets liquidations, that's when you can get some really good scalping opportunities and just kind of short-term trade opportunities within the market personally. But again, it's not my expertise. I don't want to talk like I know too much about it. For me, I like to focus on these longer-term timeframes, and that for me is how Bookmap has been incredibly valuable. So I do want to talk about kind of a solid strategy because we looked at a weekly time frame and how cumulative volume delta can kind of expose what's really going on behind the scenes to prepare for maybe a broader trend. But 1 week's worth of cumulative volume delta is not enough. As you all heard earlier, I review it basically every week. I'm constantly tracking cumulative volume delta every Monday to review the prior trading days, the past 7 days of price action. and more specifically, the market order flow through that cumulative volume delta. So I want to go ahead and share my bookmap strategy. Again, this isn't the kind of end-all be-all for me to go out and make trades, but it is one of my big confirmation signals that can give me a backbone foundation towards making one of my trades, whether it be to the long side or the downside, right? Essentially going long or short. So as a swing trader who's trading with that 1 to 6 month time frame, I'm looking to track cumulative volume delta on a weekly basis. I make it my routine to come in every Monday in the AM, pull up Bookmap, pull on that 7-day time frame, and essentially I even have it set by default. Once I have that pulled up, I can see whether or not it's positive or negative. And if we're in a position where we're just constantly having chop green, red, I'm not looking to trade in that environment because there's inconsistency within that market order flow. Bids on the order book, again, basically in this case, limit orders, bids or asks, the heat map is important, right? That is significant for sure. And there's always going to be equal buyers and sellers. There's always someone matching on the other side of the trade. However, that cumulative volume delta or market order flow is what drives bull markets. If I'm not seeing consecutive weeks of positive cumulative volume delta, I'm not too interested because I want to trade those big trades over multiple months and potentially expand this out to a year plus, right? If we're really in a full scale bull market and not trade too much, I just want to ride the wave, right? So if I see cumulative volume delta is positive or negative for 3 to 5 weeks, I'm starting to see conviction in the trade. I'm starting to see that there is a chance for a multi-month reversal. The foundation is starting to establish itself. I don't really, care so much about what market makers are doing, what the bids or the outs on the order book are doing. I'm seeing that there is a lot of pressure here on one side of the trade. And that's the kind of pressure that can really lead towards substantial moves, and especially a thinly traded market like crypto right now. That's why I think we saw this 100% move, is that there's not too much liquidity in the system. It doesn't take too much. And that's kind of telling here as well with what we saw with these stablecoin metrics. Along with that as well, if we do find that we have that kind of positive or negative setup and we got to go long or short, we essentially are waiting for cumulative volume delta to do the opposite and repeat this step. If we're starting to see that for 3 or 5 weeks, we're seeing changes in the opposite direction. If we're seeing growing inconsistency within the overall setup and we're not seeing that week by week green expansion, right? Again, price doesn't always have to make new highs every week. It doesn't do that. It will have corrections. But if we're just, not seeing that constantly, generally we're outweighing much more, kind of positive weeks in the cumulative volume delta versus down weeks. That's spelling a lot of issues in my mind personally. And that's making me think that, okay, it's time for a trend reversal, time to get ready for the setup. And this right here is exactly what we've been seeing here. We had multiple weeks of positive volume delta, many months, if you will, during these periods of time when we had rapid expansion in January and the period of March. These really 2 big leg ups here, we saw lots of continued positive cumulative volume delta. However, we are seeing, while price action is relatively stagnant right now, we are seeing massive red cumulative volume delta or market sell side pressure. So that's the way that I personally use Bookmap here. But I think, again, overall, everyone's got different strategies because they trade on different time frames. For me, this is something that will help you guys make the big trades. As much as there are those of you out there who might like to day trade, I don't want to get in a debate about which ways is best to trade. But as many of you know, the statistics, the shorter time frame you're trading, the more likely you are to lose out to the market. The more leverage you're trading with, the more likely you're to get liquidated or stopped out. I'm not really big about doing that because there's already enough great markets like crypto that offer us the kind of volatility to be able to make some substantial moves in both directions and make great returns for that matter. So I really want to capture the bigger moves. And, as a lot of people are focused on, rightfully so, they want to know when we're going to get this next kickoff of bull market so you can just ride the train and enjoy it, right? It should really be simple. It shouldn't be something too complex. When we're seeing this, though, for the first time in history, this makes me think that for the first time, Bitcoin is going to experience more than a traditional bear market. We are about to experience a longer term liquidity contraction. And this brings me towards the macro topic that I want to discuss, the macro conditions. I want to talk about the United States Central Bank balance sheet, the M2 money supply, Fed funds rate, and we'll dive into bond markets. I know some of this might sound a bit boring. At the end of the day, it's not as exciting as crypto, but I think a lot of you out there are probably relatively, kind of tapped into these areas as well because you're probably trading equities as well and kind of a broad macro class of assets. I'm the same way. I like to trade across not just crypto, but also the broader markets as well. So let's take a look here at the United States Central Bank balance sheet. A lot of people look just directly at M2, but I like to look at the balance sheets as well. And I do look at the United States balance sheet. I look at also balance sheets in Asia, like Bank of Japan, the People's Bank of China, look at the ECB. But generally speaking, at the end of the day, the most important balance sheet you can track here is the United States central bank balance sheet. It is tied to the world reserve currency. The Fed, with having the world reserve currency and the monetary policy tied to that currency framework, they are really going to lead the charge globally. And we saw this over the past year, especially in inflationary environments where the Fed really led the way first on tightening efforts, and essentially other central banks like the ECB and others started to follow suit as well. They're stopping stimulus efforts in the case of countries like Japan, or more stringently cutting interest rates, increasing interest rates and tightening the balance sheet like the ECB or the Bank of England. Now, one thing that a lot of people started to point out towards, and I really had to kind of go through a couple of weeks where people were berating me about this, and they were talking about, Nick, while the central bank has been tightening the balance sheet since April 2022 into February, really almost coming up on a year here, we had a major deviation where for a couple of weeks we expanded the balance sheet. This was from the banking crisis that we saw. There was a lot of run on the banks. Silicon Valley Bank went under, First Republic Bank, and then also, of course, there was, I think, Signature and Silicon Valley Bank. Those are kind of the three big ones. And not to mention, those are big players in the crypto space, which kind of explains why stablecoin liquidity is flat here. Those banking on-ramps are starting to shut down. Silvergate as well. Another one. Again, just all these players got really crushed during that period of time, and that's setting a setback on stablecoin liquidity. But it's not just the microcosm of crypto that's really a concern here. It's really global liquidity, because we talked about how this was going to be a short-term blip on the channel because of the fundamental fact that this expansion here is not traditional QE. All right, so that's where this metric can be sometimes a bit deceiving. We need to understand that essentially this was a short-term wave of relief for various different types of banks in order to satisfy against potential bank runs, bolster liquidity, and was essentially a short-term package for the Fed in order to help these banks start to prepare for a more tightening environment. And you can see right here and there that one thing is very clear. One, that credit is starting to contract, but also traditional quantitative tightening is still on autopilot. This is one thing a lot of people missed on and they've been ignoring from the Fed meetings. Week by week, we're contracting by tens of billions of dollars of liquidity. This week alone, we had a minus $58 billion from the overall money supply. That's a contraction of 0.7%. Might not sound like a lot, but if you keep doing this every week, you're talking about reducing a lot of the money supply, given a couple months' time, which is what the Fed is likely going to have to do, and why we've had kind of mapped out here that we're going to have to probably bring liquidity somewhere in between where it was during the kind of COVID stimulus that we saw from 2019 balance sheet expansion all the way towards 2022. So liquidity is still contracting here. That's not a good sign. Another way of measuring this is taking a look at the M2 money supply. This is, again, only on the monthly time frame. So we need to kind of take it again here with the monthly trend, and month by month here, we're seeing that the M2 money supply is not only dropping here, but it dropped at its most dramatic rate in March, down $257 billion. So global liquidity is contracting. It's not just crypto. So the macro inflows are nowhere to be found. Stablecoin liquidity is nowhere to be found. And once more, the cost of capital is getting more expensive. I was kind of in the contrarian camp over the past couple of years. We constantly heard lies from the Fed that inflation is transitory and that this was going to be a short-term ride. But at the end of the day, inflation kept moving higher. And whereas a lot of people thought the cap for the Fed funds rate was going to be around this range, where we were in April 2019, where we pivoted last time, we were calling back over a year ago that this was going to go to 5% plus. And we know that essentially we're going to be going here towards 5%. But I think now we need to be prepared for a trading environment. And this is what I would say to anyone who's thinking about the bullish narrative here. I'm not saying we have to go to this range here. We'll have to see how the Fed continues to play it out with the inflationary metrics. I think 5% was the level I was quite confident in at that time. But the question I want to ask here is whether or not traders who are buying in this market, who are swing trading, trying to buy every single dip, dollar cost averaging, or trying to kind of swing trade and bet on a new bull market, what happens to Bitcoin if we come up into 6 or 7% range? And I know this sounds like I'm talking out my rear end. I'm in la la land. This can't happen. We were just up here in the early 2000s. We're back here during the 80s. And we went much higher during that period. Again, very different macro environment from where we are now, but the same inflationary pressures. And The question we have to ask ourselves is, if inflation is as sticky as it is still now, minus like energy prices, and if we're talking about housing, rent costs, food, and other basic commodities or products or services, if that inflation continues to stay in this range and it's not dropping like a rock, and the Fed still has, at a minimum, even at this current trajectory, according to the CPI and the PCE, has well over probably around 9 to 12 months before it is going to reach its 2% target. If we know that it's going to take that long and that the Fed has to keep it there, how far is the Fed going to have to take the federal funds rate to get to its objective? How quick is it going to get there? Because if we kick the can down the road, we know that inflation is just going to get worse. And I think that Jerome Powell and the Fed know this. This is why it's so important to watch these metrics. Last thing I want to take a look at here, guys, just to keep it open up for some questions, I want to take a look at the US 10-year yield. And I don't want to just take a look at the monthly. You know, as I talked earlier, I like to look at the long-term time frames. And man, this chart speaks louder than anything. You know, bonds to a lot of people can be quite boring because they're fixed income products. You don't really, I mean, you can trade bonds if you want, but it's really a very specific type of traders who watch these markets and trade them. I'm not even here to say you need to go out and buy bonds or do anything, but I want to say this. You know, that trend magic indicator that we utilize here, for the first time on the annual chart, I'm talking about each of these candles is an entire year here. So we're looking back over nearly 100 years here. For the first time since 1950, US 10-year treasuries on their yield have flipped blue after more than 30 years of downward trajectory. Now, some people would say that this is just up here for a little while, and then we're going to fade back down when the Fed pivots and goes back down to 0% interest rates. Here's the thing. This chart here, I think, sends a very clear signal that maybe we don't go as high here as we did in the 70s with runaway inflation, but by addressing it early, we are going to probably hang in this range for some time, that the Fed funds rate is going to stay suspended for longer than people think. That we are in a new era here. The 80s to the 2020s were a period of high growth, high expansion, high innovation. We had the internet, we had smartphones, we had advancements in biotechnology, we had enterprise software solutions. You had all kinds of things that created trillions upon trillions of dollars of value. But if you take a look across the macro scale now, not only is the liquidity contracting, but you're seeing a lot less innovation, a lot less risk taking. The thing that is driving stocks like Meta, that's driving stocks, all across the board here, and the FANG stocks, for example, that were previous market leaders, they're rallying off of the idea of layoffs and cutting costs. And one of the key things that I think a lot of you probably already know about, it's the same thing for crypto or stocks, is that equities move up not off of pure fundamentals all the time. They move up through paying a higher PE multiple versus the actual core earnings because of growth expectations. And if growth expectations are not there, then we've got a big problem. Because as bond yields start to move up, as we enter into a contractionary environment where rates are higher and therefore bond yields are higher, or the cost to borrow capital for the government gets higher, that this is going to make it much more lucrative to just simply buy passive income vehicles like treasuries. Why go out and trade the S&P 500 when I can go ahead and on a 10-year yield get 3.7%? Not to mention, I can buy residual 1-month yield treasury notes right now, and I can earn 5.7%. That's better than any savings account. It's better than any the vast majority of investment vehicles, unless you're really the type who's trading Nvidia, or something like that's really kind of risk on, which is nothing. There's nothing wrong with that as well. Then this is going to kill the liquidity inflows to risk on markets. The higher this goes, the worse it is. And back in the 70s and 80s, you can go back and take a look during this period of time. This was not a rapid period of expansion for property markets, for equities. It was a chop period. We can take a look at the S&P 500. Put on the log scale. We can see here during that period of time, back during the 70s and 80s, right? We didn't really reclaim a new uptrend for over 12 years. Right? We didn't have some, massive pullback. We did have a period of time where we went from around 122 points down to 62, 50% correction. That's what I would expect here. Nothing too doomsday-ish, but essentially a lot of chop, a lot of uncertainty. Only until then, once inflation was resolved, were we able to have a period of expansion. And this kind of leads me towards my close here. Last one is of course, the yield curve inversion. We can take a look at the US 10-year yield minus the US 2-year yield. Excuse me, mistyped that. This is kind of the close here. Put in the candle chart, monthly time frame. This is the greatest yield curve inversion that we have had in our history. And as you all know, the yield curve inversion is a leading indicator, like here it was in 2000 or in 2006 or in the 80s, about an upcoming recession. And we've never deviated this low before. What does that tell us about how bad things are about to get here over the next coming years? The last thing I'm thinking about touching is a risk on asset like Bitcoin. And I've covered crypto on my channel since 2017. I think crypto it has a place in my heart in a lot of ways. I think Bitcoin will always be a relevant asset in the world, but I think we got to get ready for a changing environment. So I rambled on a little bit longer than I intended, guys. I appreciate you guys making the time for letting me go on a little bit and talk about some of these charts. And would definitely love to open up some questions. Hear your thoughts as well, Bruce, because I really respect your trading strategies and just kind of overview on the market. But yeah, thank you guys for giving me some time to chat.
Okay, excellent. Thank you, Nicholas. Really interesting stuff. I don't see any questions, guys. Get your questions in on YouTube or in Discord. What Nicholas is going over is vitally important. I mean, this is, the if you look at the bonds and interest rates and the Fed action, this is really what drives markets. The cost of money is and how much money is out there in supply. These are really amazing things to understand or comprehend and watch here, because it drives the market. And boy, you're painting a pretty bleak picture here, Nicholas. But
It feels a bit foreign for me, Bruce, because I'm like I've been so used. I've only, to be completely fair, I started trading in around like 2011. So it was, yeah, about 2011. So it's been over about 13 years. About 12 years since I started my trading journey. And back then I grew up in basically this period of time where the bull market, the secular bull runs we went through for the last decade, which was Fed driven, the mantra was buy the dip all the time. And that was great during that period of time. But when you're in an inflationary environment, exactly as you said, because of the contraction of liquidity and the cost of capital, there's just no way to have that kind of buy the dip mentality anymore. People would rather take excess money, and every time you're getting those higher bond yields, I mean that's all you hear about now is people are switching their money to money market accounts, place they get a better yield on their money. They're playing defensive to hedge against inflation, and now you can get yields that practically match the rate of inflation in the economy, which is why liquidity is pretty much frozen from going into these kind of markets.
yeah,
Or more of
yeah.
the risk on markets. Yeah.
Yeah, and you can see the money. I mean, on this chart here, I mean, you can just see it flowing right out, and with the inversion curve there.
Yeah.
Um,
Uh,
but yeah, I mean, if you go back to your bookmap slide for a minute, I was just
mhm.
something like I wanted to mention in here, and it is very much related to your cumulative volume delta. Is the This is something that I personally saw years ago in crypto when it was around 20,000 and then broke to 60. Uh, Several days cumulative volume delta, and I'm not so much the CVD line itself. It was the volume bars and the dots that you have there.
Mhm.
It was just like solid green. Even though there was ups and downs, and it was actually quite sideways during that time, but it was nothing but accumulation. It was amazing to see. Here, there's a little bit of buying. You can see, like I'm looking at the bars, the volume bars
Mhm.
on the subchart there. Yeah, and there's a little bit of buying here and there. Some years ago, before that big break, it was nothing but green, day after day after day. I mean, like for a long time, and then it just shot up to 60,000. It was incredible. So yeah, I was watching this actually pretty closely as well, and I wanted to ask you about this, and I'm really glad that I can see you looking very much right at it here with the cumulative volume delta, and it's yeah, I mean, just look at all of that selling, and price is still going kind of sideways. It's something's a little off, you know.
Yeah. That's the thing is that it's kind of confusing because when you see exactly as you said, Bruce, like in the counter scenario, you can have price kind of going sideways around that 20K level that you were talking about. before things just start to explode. Yet at the same time, price is generally still pushing sideways, and vice versa here for like big moves to the downside. You can have a lot of negative cumulative volume delta, and I think the reason for that is because you do initially have bid side support. So as we talked about, there's always going to be a trader on the other side, and that's what happened here. You know why prices bounced up in the near term. There was a nice layer of bid side support on the heat map around 26,400 and 26,500. And you even have these kind of heat levels here that changed and varied over time. But if you really kind of scan out, I could even pull up Bookmap here as well. Give me one moment, and I'll pull it up here real quick, and I think I've got it here. There we go. So you guys can see this good.
Yeah,
Um,
yeah. I mean,
cool.
and look at that around 8 o'clock on the 20th
Mhm.
there. That massive spoof of liquidity on the bid, and that just
Exactly.
and then look at the liquidity up above on the offer. So it really looks like these guys are trying to get price to get up there, so that maybe they can get filled around that 27,500 or so.
Exactly. Yeah, that's the problem is that with the heat map, yeah, you always have to look out for spoofing. And when I see things like this, exactly as you said, Bruce, I'm thinking about okay, what are these people trying to kind of push? What direction are they trying to get filled? And exactly as you said, when you have the liquidity in both directions, you can really do some pretty nefarious things and stuff on the order book. And that's why I kind of zoom out. And I'm thinking, okay, let's squeeze the price action here, look at the long-term time frames. Over the week here, we've just had constant bid supported around,
Yeah.
25,000. So that's really since like, generally speaking, as I'm seeing these kind of big weekly outflows of cumulative volume delta, that's always my next target. It helps me to kind of not, if I were to do short-term trading, or even really those big swings, I'm looking for, okay, we've got one really big bid side support here because if that essentially does not get if that gets filled and we start getting cleared down, right? There might be some other order book bids that come in, but that's probably going to clear us for another couple $1,000s to move down. And it wouldn't be too surprising to see something relatively big because that's exactly what we saw in the counter direction. Markets chopped sideways from November to January. And basically started ballooning out of nowhere when cumulative volume delta took over. And I think, again, as you mentioned, like with the 20K metric back in October, November 2020, that's exactly what we saw in that period of time. I feel a little bit bad because I went against my inclinations there. There was a lot of things at the time in the macro conditions that didn't look good to me. But I did notice when I was looking at Bookmap, I saw, man, CVD is positive. Like the majority of the weeks down here, what's going on? And that was again how I missed kind of that initial first major move in January. That was the telltale sign. It was one of the only major metrics that was really flashing that for me, and it's unfortunate. But yeah, I think at the end of the day, that is again a time-tested example, similar to the one you mentioned in October of 2020 during the last bull market, that it can really be quiet and then something major happens. And that's again between accumulation or distribution. Right now, I think we're seeing, typical distribution here. It's been every week I've been looking at this and I'm getting a read between generally, I think the last couple I checked was around like minus 5,000, usually minus 10,000 or 8 or 9,000. I'm generally seeing really negative cumulative volume delta, and this is measuring Binance and Huobi. So we're getting a lot of, and this is the tether pairing as well, which I care much more about because liquidity is generally quite deep these exchanges. And generally speaking, overall, I think this is one of the best, deepest order books that we can take a look at here. And if Bitcoin is not leading, if there's not people getting excited at these prices, and the order book is relatively thin in both directions, volatility can pick up really quickly.
Yeah, yeah, absolutely. And look for that break. I mean, it might be your longer term trend line break that you were looking at earlier.
Hmm.
Can you just do a thing here on the price ladder? Hold the control, hover over it, and then hold control down, and then scroll, downwards.
Let me see real quick.
So
She
you
said,
you zoomed vertically before, but what I'm asking is like now
uh-huh.
hold control down and then hover over the price ladder there, just right over the price ladder. Hold control down
Hmm.
and then just go down in price because I want to show you something. No, now hold control down as you do that.
Yeah. Oh, there we go. Am I doing
Okay.
that right, sir?
Not quite. Like you, if you hold the control key down and scroll, there you were just starting to do it. Well, anyway, there's an interesting thing. Like you can go and see that there's a lot of liquidity resting down around 5,000, and uh, even some like a year ago it was down at like uh, 500. So people were betting it was going to zero, basically.
Wow.
And I mean, you can see quite a bit down there around, I don't know, 11, 12,000 right now.
Yeah.
And, there's a lot down there. In fact, we had to, um, with the development of some of our add-on indicators, we needed to readjust the indicator to because the book and balance was so great with that liquidity down there, we had to actually exclude it from the calculation. Um,
Wow.
yeah, I mean, this is telling here. It's saying something that might be. That's what a lot of people are thinking the value is down there around that 11,000 or 12,000, something like that.
Yeah, exactly to your point, Bruce. Sorry, by the way, I couldn't get the thing set up properly, but you're exactly right about like this kind of figure. I've honestly always I try to scroll out, see where the heat map is, and that really might be the price floor. I know a lot of people are like, if you miss the November lows, you kind of miss the absolute low. FTX can't get any worse than that. But the problem I think people have is they see kind of the immediate destruction of the industry with these big exchanges, Celsius and BlockFi going under, as the kind of end all be all. It can't be any worse, right? We've kind of cleared out all the skeletons in the closet, but exactly as you mentioned, Bruce, like you got to look at the order book and see like, hey, okay, like if that's the low, like where are the institutions who are going to provide that bid support? And we have some here. We have our typical kind of range that we can look at where there are some bids, but really, if this gets cleared through, then there isn't much outside of this kind of 25, 24K range of potential bid side support until we really get down here. And that will probably change over time. Maybe it gets a little bit more dense, but this is where really, as you said, the liquidity really ramps up. Like people are really willing to buy down at that kind of 12, 13K range. And I think that that makes sense because if you look at like just even a traditional crypto bear market, usually we have a correction over 80%, usually roughly around 83 to 85% for most bear markets. And if you take it from the all-time highs at around 65,000, you kind of get to that ballpark figure of around like 12K. It's not too far off from a traditional bear market. So yeah, I think that again, it's a clear signal here that there's not much else liquidity that's going to be providing that bid side support. So if we start getting even further massive cumulative volume delta to the downside and market order flow. And people start looking at the narratives like the $1 million Bitcoin price predictions we were hearing about and the bank runs and de-dollarization because of, BRICS and all these global alliances that might be trying to take on the dollar. Dixie, the dollar index has been moving up. That's basically where it was in, I think, like November or December of last year. So 6 months of practically neutral price action after its pullback, and it just had a blue flip on the weekly time frame for the first time since June of 2021 on our Trend Magic indicator.
Hmm.
And so I'm seeing dollar strength. I'm seeing treasury yields going up because they're estimating the Fed's going to be pricing higher interest rates. I can't. There's very difficult for me to get really excited about crypto here. And we got to ask, if those narratives that we were talking about earlier, they fell through, then what is going to drive Bitcoin's price to new all-time highs? What's going to justify us going back to even, 40K, 50, 60K, let alone $100,000 like a lot of people are calling for. So, yeah, that's what I keep coming back to, unfortunately.
Yeah, yeah. There's a few questions here in YouTube, and I'll get to them in just a second. There's something else I wanted to kind of wrap or include into that question. Is how would you, since you're a longer time frame trader, you are looking to build a position over time, and I imagine like on the way up it was buying the dips, and or if it's something else like on the way down now, are you building a large position looking for that move to the downside, or are you just exiting altogether and just not really want to play in this field?
That's a great question, Bruce. Yeah, I've been in cash. We basically, for the first time in a long period of time, we liquidated a lot of our positions at around a Bitcoin value of $25,000. As I referenced a bit earlier, for the altcoin, we were exposed to a lot of altcoins, and that was really, that relief rally was a great exit opportunity. For some of those positions, we should have gotten rid of earlier. As we were a bit late to picking up the macro conditions around inflation. But because I was really kind of siloed a lot into the crypto space, so it's something I learned from greatly, and I took advantage of that opportunity, which was a really like a big blessing, I think, in disguise. But the big thing around like my building of a position going into the next bull market, so I'm in cash right now, but for me, what I really want to kind of wait for here, see whether or not we're able to hold on the 200-day moving average. I can pull up the chart here real quick. I'll switch screens. Let's see here. I'll get it back up. There we go. So I'm looking, if I go to Bitcoin, right here to the daily time frame. One of the big gauges, I mean, obviously the momentum indicator. If we get the red flip, that's my cue. Considering the cumulative volume delta and Bookmap, the red flip on Trend Magic, and also considering the tightening macro liquidity, that's my kind of three cues to go short. And I think that'll be a multi-month setup similar to the multi-month uptrend we had here,
Hmm.
to potentially, make a good like 30-50% short, might do 2x leverage and kind of double those returns, hopefully double the risk profile. But for me personally, I'm looking at a short here in the near term. But once we get back into this kind of accumulation range, I look at things like VWAP. I'm looking at cumulative volume delta. Whenever I see those flips start to come in, I'm going to start accumulating week by week, probably about like 10% of my portfolio into it. Another kind of DCA strategy that people can implement if they're looking to take more of a traditional investment approach, they can do it where essentially, you take the existing market price now. If you think you're nearing a low, you can basically have it where for every 10% decline, let's say you have $500 in capital that you have set aside. It could be $250 of savings that you have and $250 of weekly income that you want to just park away for the future. What I like to do is I don't like to just DCA all that capital, right? If we're still in a broader term downtrend, what I do is do small allocations. So I might start off with 10% of that $500 or $50 every week averaging in. So I have a little stake in it in case it starts to do really well, so I don't miss out entirely. But if we start to get more corrections, say like another 10% decline from the existing prices, then I'm gonna bump that up to, for example, 100 or 150. I start to accelerate it. And the more 10% declines we get, I'm essentially getting to a point where I'm going to be using my full capacity, 50% from that range. If we go even lower, then I'm going to start pulling into some of that additional capital that I didn't use in prior allocations and go heavier. It's a bit of a unique dollar cost averaging strategy. Like I was originally had a startup and we wanted to focus on people getting paid in crypto. And one of my big focuses was going to be doing smart DCA, where when data science models are oversold, when price action is generally just on a kind of a range oversold, that's when we would average in heavier, and you don't have to stress too much about what the price is doing and have all the emotions of trading. But I personally, for me, I'm more of an active trader. So for me, I'm looking for that cumulative volume delta to start showing some positive weeks that are going against my kind of bearish narrative here, showing a sign of a trend flip. I'm looking for a blue flip here on Trend Magic, and I'm also looking for generally price action to show that kind of accumulation pattern of sideways price action. One of my closing remarks I'd want to make here is that if people don't believe this was the bottom here, I would ask them what they think this is. Because it's it's almost a screaming example of the same price action. Huge candle here, 26% move to the upside. Back here was 22% move to the downside, and a bit of chop for about 2 months. That's about what we've done here. And that's why, again, I would say to not get siloed in the idea that this had to be the bottom. And that long term, people always point towards the logarithmic chart. This is where it gets a bit kind of chilling, if you will, like towards that macro thesis we talked about earlier. Bitcoin has always kind of had the logarithmic growth curve people have talked about. And while a lot of people are relying on that and their different interpretations and drawings of it, or the rainbow chart, or whatever data science models people might turn towards, those models, I think, of the last decade are likely to be broken significantly. And it wouldn't be surprising to see Bitcoin have a period of time where, if interest rates remain where they are now for a year plus out from now, where it comes down into this 11, 12K pocket. Again, just like kind of extending it out. The kind of drawing I had here of how I thought price might play out. It's just a rough sketch. We don't know exactly when it would happen, but the idea would be we have another extension lower, set in a third lower high around that range at around 12K. And that's where, again, you can start to get significant accumulation, not only a discounted price from this range. So you start getting people who are starting to buy around here, and you really have, again, some of those big bids that you talked about. I was interested that you brought that up, Bruce, because I've watched that as well on Bookmap. I think, again, roughly in that range, you're going to get kind of a big capitulation candle, big wick. That's when a lot of bids are going to get filled, and it provides any ample buy side support to keep prices from going lower. So,
Yeah.
yeah.
Yeah. Great stuff. Do you have a moment for a few questions?
Yeah, absolutely. We can go through any. That'd be awesome.
Okay. So crypto here is asking, what is the co-relationship between Bitcoin and the bond market? Are they inversely related?
That's a good question. So I would say that while there's no absolute direct like correlation or inverse correlation, the idea is that Bitcoin, I think, as an asset, people have a misconstrued narrative here because of what we want to believe Bitcoin is. A lot of people want to believe that Bitcoin is this kind of risk-off asset, this digital gold, an alternative hedge to gold and traditional fiat currency that allows us to store value somewhat outside of the traditional system. It's an asymmetric asset. And while that's true, it is kind of asymmetric to some degree. If we look historically over the long term, Bitcoin made its greatest appreciation during a decade of central bank liquidity expansion. So it was a store of value in many ways that helped us to hedge against inflation, but it helps us to hedge during the periods of time where there's not inflationary pressures, but more specifically monetary expansion. Right. So when Bitcoin reacts much quicker, its investor class is much more aware of central bank liquidity, the dilution of money over time, the dilution of the value of that currency, and therefore are looking to put it in alternative hedges. However, Bitcoin, on the other hand, has been really kind of flat here. If you're kind of building this kind of zigzag pattern here, really since 2017, as we had this blow off top here on a logarithmic scale. So we're not expanding like we used to, and the reason why I think is because we're starting to see investor capital, like dollars in the economy, credit, any potential like money that can go towards financial assets. It's going towards what's going to give them the best guaranteed yield, and that really takes us to talking about bonds. U.S. 20-year yield is at 4% now. That's up from, I think, at the lows. I know at least for the U.S. 10-year yield, it was, I think, 0.5%. Yeah, sorry, excuse me, actually a little bit lower, but let's not go off the wick here in March 2020, like around 0.6%. So no one was, really touching bonds outside of those who wanted to speculate on the bond price, because there is an inverse correlation between bond prices and bond yields. Bond yields, when they go up, bond prices go down, and vice versa. Usually, when bond prices are accelerating higher, the yield is going lower. So the only people who are doing that were just trading for the spot value of those bonds. Ideally, when yields go up on bonds, we are going to see Bitcoin go lower because Bitcoin doesn't pay yield. Bitcoin is, whether we like to admit it or not, it's seen as a speculative asset. The vast majority of banks, the vast majority of financial participants are not allowed to take money that they're managing in pension funds or different types of retirement accounts, traditional funds or hedge funds are not allowed to put capital in crypto. Maybe at most they can put money into stocks like Riot or MicroStrategy to get that kind of pseudo exposure to the space. But when it comes to like the real spot demand we need to have for Bitcoin to move higher, it's going to be difficult to find because the institutions can't be that support because treasury yields are so lucrative, or they're going towards more defensive plays like equities, which they're legally allowed to put capital towards. If on the other hand, yields start to go down and there's a more risk on mantra, regulations start to ease off, then cryptocurrencies can do really well. Bitcoin does really well. The yields are on bonds are going down, makes it more lucrative to start looking for Bitcoin. So hopefully that answers the question. There's no direct correlation, but I would say if there is, it's an inverse correlation at the end of the day.
Okay, great. And then crypto is also asking, we got two more questions and that's it, about the magic trend indicator. And you don't have to go into too much detail, but just kind of maybe the overall again. He's asking, instead of saying like, well, go back and watch the recording, maybe you can just answer. He's asking if it's similar to the EMA crossover, superimpose them, or
Yeah,
how you read them or how it is calculated, I
that's
think.
That's a very good question. It's a bit difficult. There's a good description on the indicator that will talk. It basically uses average true. I think average. If I might be missing on the names, there's so many indicators out there. I think it utilizes the mixture between the average true range and also the commodity channel index. And essentially, the commodity channel index was utilized. I mean, it's been utilized for a long period of time. I like this indicator because it's been around in of itself for over almost coming up on 3 decades. But on top of that as well, the core indicators underneath the actual indicator itself have been around for a long time. The commodity channel index was basically utilized to spot discrepancies away from the mean, like a kind of like deviations or separations from the average price. And the average true range is relatively similar in some means. But the way that the indicator kind of functions and utilizes those measurements, it's a bit more difficult to explain. My major thing, though, that I like about it overall, like keeping it really simple, is that I've seen a lot of different types of indicators in the crypto space that say, "Oh, we've built a custom indicator that that trades the crypto space really well." For me, I always take any indicator that I see and I plug it into the long-term time frames and I look at it across other markets. And if it doesn't hold up, then I'm not really interested in it at the end of the day. For me, though, the trend managing indicator has been one of the most consecutive. It's one of our biggest ones in our newsletter group that we talk about. And it's, while it's not end all be all to make any given trade, we do need to have other conditions, narratives and things like that that can play into it. It's really good on these long-term timeframes, just letting you know, hey, when the game is up, you know, the good times are over. It's time to get ready for the downside, and also when it's time to get excited again. I just pull it back here to the Bitcoin chart, and to have an indicator that's this consecutive, of course, with some small blips like the March of 2020 dip we had, which was kind of an anomaly across the board. This is usually one of the best indicators I've seen at tracking the higher moves. It's not perfect at timing tops, obviously, because you're looking at a monthly time frame, so there's a delay. But essentially, there is a pivotal point. We had a cool member of the community, our newsletter, come up with a really cool tool that tracks what price would need to get to before we get that flip. So that makes the indicator even more useful because sometimes you're kind of wondering with the TM. The one confusing element about it is the price can cross it, but it can still be red. So this is another additional thing where they measure the pivot for the indicator. So yeah, again, I wish I could do it better justice. It's a bit difficult to explain, but yeah, those are the two fundamental elements that make up the TM.
A question on that: is it the average true range of the commodity index, or is it average true range of Bitcoin compared to the price of the commodity index?
Of Bitcoin. Yeah.
Okay, okay.
Yeah.
Let's see here. One more question. Hi, Nick. Do you reckon that Bitcoin will still follow the regular 4-year uptrend in this cycle? How high do you expect, anticipate? And that's it. But this was a while back, so you might have already answered it. But anyway,
No, that's a great question, Bruce. Yeah, we didn't talk about it too much earlier. I did make the case earlier though that we were talking about like how this would extend out further. A lot of people believe we're in the next 4-year cycle, and I think that this right here is kind of the proof that we likely aren't because we weren't able to get up towards around 32, 33K where we would have gotten that change here. It shows us that this bear market hasn't gone on for long enough because of the contracting liquidity and that we've been through a decade of expansion. I think that the reason why people look at the 4-year cycle is something that is time tested is because not only did it hold up pretty well over these past couple of years, but it's paired with the halving event, which is a contraction in the amount of Bitcoin that gets issued. So basically, the money supply inflation rate of Bitcoin drops in half every 4 years. It's programmed in, and while that's a really cool thing about Bitcoin, we know where the cap supply is. The halving loses its effect over time, and people would say, "Well, what do you mean? It's dropping 50% every time? It's the halving. It must be the same exact consistency." That's actually not the case because if you take, for example, way back in the day when we went from I think it was roughly 50 Bitcoin block rewards in the early days to 25 Bitcoin, that's a massive reduction. That's 25 Bitcoin less of a capped 21 million coin supply. However, if you go a couple halving cycles out and you're essentially getting to a point where I'm just kind of using this as a mental example, it's probably not what we're going to go from. I forget the number at the moment, but if you go from say like 5 Bitcoin per block to 2.5, you're now basically reducing the inflation rate by 2.5 Bitcoin every 10 minutes. So miners are slowly but steadily over time losing large amounts of relevancy in the crypto space. And this is why, even as the mining industry has expanded, it's not going to be a good industry to be exposed to because uh, they're competing more and more through over a higher hash rate for a smaller amount of Bitcoin. Putting aside the mining part of it, though, is just basically it gets to a point where that halving reduction is redundant when I'm going towards the more bigger question: are there generally more buyers or sellers in the market? If the halving of it happens and we start having just 2.5 Bitcoin versus 5 Bitcoin every 10 minutes, that's all fine and dandy. But if Satoshi comes back and unloads his wallet and sells 1 million Bitcoin, or we start seeing MicroStrategy or large stakeholders, already existing holders in the ecosystem, selling much more than new buyers are coming in, then the halving event doesn't really matter much. And that's a fundamental reality we need to keep in check, which is that the halving of it is just becoming less and less relevant over time. And that's why also the multiples on Bitcoin with each cycle generally are degrading. A lot of people point out that this bull market wasn't nearly as exciting as the move we had from, say, late 2015 to December 2017, or the bull market from November 2011 to November 2013, or the first cycle expansion in 2009 to 2011, which again is really early days, but you get the point. Like it's losing its relevancy, and that's not me trying to insult Bitcoin or anything, but it's just math. At the end of the day, the mining doesn't matter as much as it used to.
Excellent. Interesting stuff. Really fascinating. I bet you're probably going to see a lot of fireside sales of a lot of computer equipment in the near future, if
Yeah.
Bitcoin is dropping. But just speculating on that.
Yeah, no, I mean there's this whole business built around like ASIC miners, and and that's one thing I bring up about Nvidia. I know a lot of people are really excited about Nvidia, and to be honest, it's one of the few stocks that has got the monthly blue flip. And usually I would look at this and go, oh my gosh, this is gonna go. If we were in an expansionary period, I would look at this and be like all in on Nvidia. But I have to say, Nvidia as a company, this is a good example of like what's going on in the stock market. All the liquidity is cycled right now into this one of the pretty much one of a few plays in the market, and I think it's again it's a telltale sign here that with what we're discussing, basically that there can be these short-term trends and stuff. People get really optimistic in the market. I think the PE ratio is at 181. And the thing is that, a lot of this is betting on AI. But at the end of the day, the majority of NVIDIA's business is not just infrastructure, GPUs for things like AI. It's for gamers, people who are playing video games. And if the consumer isn't strong and the consumer's not buying really expensive GPUs, then Nvidia stock will eventually come back and correct once the trend loses its momentum, reality sets in, enough quarterly earnings reports come out, and they don't show the growth, then Nvidia will correct down quite sharply. But it takes time for these things to happen. So my point would be like, at the end of the day, I wouldn't put too much liquidity to fight these kind of trades. And you can see again, Trend Magic just, again, sometimes you get a couple blips here, but for the most part, this will let you know when to ride the wave. And if you kind of zoom out from the weekly to the monthly, you get less interruptions, you get the broader moves, and you can make some serious returns. It's a question now of course, knowing how to find those market leaders. And I usually like to, I had a couple of tips that I just wanted to share with you guys. Like I mentioned, one of them I didn't write here is look for stocks or cryptos making 52-week new all-time highs, and that kind of plays into momentum. Whether short-term or long-term, momentum is king at the end of the day. Don't try to fight the trade until you see signs that momentum is fading. Naked trading is great, using support and resistance, but requires strict follow through. When you see momentum stalling in either direction, like we're seeing now with Bitcoin, that's a great idea. A great idea would be to lean into platforms like Bookmap that are going to give you that competitive edge that traditional technical analysis just can't do. Outside of that, only use indicators on long-term timeframes. I really don't feel the need to use the RSI, MACD, or even our TM indicator on short-term timeframes. It's too choppy, and that goes along with just doing short-term trades. I think you're much better having a really defined setup on the shorter term timeframes. When in doubt, zoom out. Always consider the macro trends and their weight, no matter how short of a time frame you're trading on. And this again goes into the using long-term timeframes. And also one thing we kind of showed here today is utilizing ratios or custom metrics. So, adding stablecoin liquidity like we did, or looking at dominance metrics between stablecoins, looking at custom lists, like rather than ignoring per se the exact percentage or sometimes the digit value that it'll give you, just looking at whether or not certain trends are expanding. Are we seeing defensive plays like stablecoin liquidity and Bitcoin and ETH dominating more of the market? Or are we seeing altcoins taking over more of the market? So those are some really cool things that you guys can do, and also things like yield curve inversion. You can use these in traditional markets. You can divide your favorite stocks that you're watching by the S&P 500 or the Nasdaq. Are they outpacing the indices? If they're not, they're probably not going to be market leaders. So, yeah, I rambled on a good amount there, but as always, again, Bruce, it's such a pleasure, man. This is a really great conversation. I appreciate all of you guys as well for the great questions. I hope, if anything, you guys were able to take anything away from it, and also as well, if there's any other additional questions, I'm happy to answer them quickly as well.
No, I think we're all good. Thank you so much, Nick. A pleasure, and it's good to kind of touch base. It's been a while, and a good timing actually, since you're looking right at these things and before the whole thing unfolds. So we'll keep an eye on it, and maybe have you again here soon, and give us more guidance.
Thank you, Bruce. It was a pleasure as always, man. Good to see you, and have a great day, everyone. Thank you for having me.
Bye bye.